Welcome back to Sustainably Speaking, where we break down the biggest challenges in ESG and what they mean in practice.
Today, we're going to focus on Scope 3 emissions, arguably the most complex, frustrating, and important piece of the carbon accounting puzzle.
We will look at what Scope 3 actually covers, why it's so difficult to measure, and as we touched on last month, how it links to regulations like CBAM and CSRD.
And we'll touch a little bit on whether technology, and AI in particular, might help address some of these challenges in the future.
Let's start with the basics. Under the Greenhouse Gas Protocol, the preeminent standard for emissions accounting, emissions are split into 3 scopes. So, Scope 1 is direct emissions from sources a company owns or controls, things like fuel combustion or company vehicles. Scope 2 covers indirect emissions from purchased energy. For most businesses, this is restricted to electricity, but it might also include purchased heat, steam, or cooling, for example, from a district heating system.
And Scope 3 is pretty much everything else. All direct, indirect emissions across the value chain, both upstream and downstream of your own operations, which for most companies makes up the vast majority of their total footprint. For BDO, for example, this represents in excess of 90% of our total carbon footprint, with 60% coming just from our supply chain.
To be more specific, Scope 3 is divided into 15 categories under the Greenhouse Gas Protocol. So it covers everything from purchased goods and services to business travel to the use of sold products.
Yeah, exactly. So upstream categories include consideration of your suppliers, employee commuting, and things like waste treatment, whereas downstream includes product use, its distribution, and its end-of-life treatment, as well as things like investments that your organization might have.
So in practice, you're not just looking at your own operations, you're trying to understand and map emissions across all the relationships you rely on to deliver your product or service, known as your value chain.
And that might all sound fairly straightforward in theory, but those who've been involved in carbon accounting know that it really doesn't take very long before you want to throw your laptop out of the window. So what makes it so difficult?
Data availability for most companies, at least to begin with. They don't have direct access to emissions or activity data from out with their own direct operations, which often leads to an initial reliance on estimates, proxies, industry benchmarks, and averages, where it can be obtained directly from the emitter. And that, of course, has the potential to affect overall accuracy. If you're estimating, you're not capturing the true footprint. And small assumptions can have a big impact on results, and especially on a compound basis, when you're adding several layers of assumptions into your calculations.
Plus, that process can be incredibly time-intensive and time-consuming, whether it's developing the methodologies to fill the data gaps, or from collecting the data directly, either internally for something like employee commuting, or from what could be hundreds or even thousands of suppliers for purchased goods and services.
It's rarely scalable or sustainable in the long term. And on top of that, consistency and comparability across datasets remain a risk for one year to another, as well as from one organization to another.
Now, BDO recently embarked on a global net zero program whereby all of our member firms made commitments to reach net zero by 2050 or earlier across all 3 scopes. And that meant collecting and calculating Scope 3 data and emissions for the very first time for a number of our firms. And providing some of the technical support on that project was Tim Higgins, the founder and CEO of specialist consultancy Sirocco. And we asked him to provide some of his expert insight into some of the real-world challenges associated with calculating Scope 3 emissions. And he gave us his top 3. So take it away, Tim.
Thanks, Malcolm. When it comes to measuring Scope 3 emissions, there are 3 big challenges to look out for. The first comes in setting the boundary and defining what should be included or excluded from the calculations in the first place. By definition, Scope 3 looks at emissions beyond your own operations. Once you begin looking beyond those emissions you control directly, the boundary of what should and shouldn't be included in a footprint can become fuzzy and difficult to define, particularly for complex organizations with unusual value chains or financial arrangements. The second challenge is often the availability of supply chain data. In an ideal world, your Scope 3 footprint would include the emissions associated with producing each ingredient, product, or service you're purchasing, based on the energy consumed in production and any changes in land use. But getting this information can be a real challenge, so we end up having to rely quite heavily on a range of assumptions and estimations. That brings me nicely onto the third challenge, which is the lack of standardization in calculation methodologies. While the Greenhouse Gas Protocol gives us a framework for measuring emissions, it's open to significant interpretation across different industries. Amongst other issues, this can make it really difficult to compare and benchmark emissions between different companies. The team behind the Greenhouse Gas Protocol is currently drafting an updated standard, which will attempt to address some of these challenges. So it's definitely one to watch.
Thanks for that, Tim, especially the reminder that the GHG protocol standard is in the process of changing. It's certainly something to keep an eye on. Now, BDO Luxembourg calculates and reports on its emissions on a voluntary basis, but that isn't the case for everyone. Regulation is playing an increasingly significant role in driving emissions accounting and disclosures across a wide range of operators who've never had to do it before.
The EU's Corporate Sustainability Reporting Directive, known as CSRD, is one of those. Even in its post-omnibus form, it requires large companies to disclose detailed Scope 3 emissions in line with the Greenhouse Gas Protocol, some of which will never have done it before.
And then there's our favorite acronym again, CBAM, the Carbon Border Adjustment Mechanism, which we talked about in last month's episode. This essentially puts, you'll remember, a carbon price on imported goods based on embedded emissions.
Meaning companies need accurate supply chain emissions data for relevant products on a phased-in basis, not just for reporting, but because not doing so will now have financial implications. In CBAM context, understanding emissions at the product and installation level becomes critical and accuracy becomes tied to cost.
And actually, the methodologies embedded within CBAM are even more restrictive, arguably, than for normal corporate emissions accounting measured under the GHG protocol, relying specifically on activity data or the punitive default values we talked about last month. So we can't use industry averages in that context. But since we're talking about supply chain, we'll dive a little bit deeper into that specifically. And the typical approach in a corporate setting for emissions in this area tends to be focused on spend data, using standardized emission factor sets for broad activity types at varying degrees of geographical granularity. But this comes with obvious accuracy risks, and the aim should always be to try and collect real activity data from suppliers as you would in a CBAM context. And this is where Scope 3 becomes especially tricky, generating accurate data from the area where most emissions are likely to lie for most firms. And you're dealing with potentially multiple tiers of suppliers, different geographies, and a widely varying level of data quality and availability in that context.
And Malcolm, not to mention the smaller suppliers, right, who may not even track emissions or have even their activity data yet.
Yeah.
But at the same time, this is where the biggest decarbonization opportunities lie. If you can start to develop insight from the data you collect and use it to influence your supply chain strategy.
Yeah, exactly. So how are companies tackling this?
They aren't the whole answer, but software tools are becoming increasingly essential. Platforms that centralize data, automate calculations, and integrate with procurement systems. This also becomes particularly significant when operating at a scale.
100%. And the critical insight you want to generate when using these tools is where the emission hotspots lie in your supply chain so you can target your actions and use your time efficiently. But even those tools depend significantly on high quality data and to some extent still human input, management and oversight.
So let's wrap this up. Scope 3 accounting is still evolving. Right now it's imperfect, resource intensive and heavily reliant on estimates. And technologies, especially AI, will play a key role in scaling data collection and improving accuracy. And we'll dive into this on our next episode. That's it for today's episode of Sustainably Speaking.
If you found it useful, don't obviously forget to share it. And if you'd like to learn more about carbon accounting or specifically some of the tools that can help streamline the process, don't be afraid to reach out and learn a bit more.
And we will see you next time as we unpack another ESG challenge. Till then, stay green.